What is the appetite right now in the shortest of short term right now?
Well, we see and have been encouraging clients to be defensive. I think one of the most underappreciated aspects of the market right now is the value of optionality in portfolios. And really, when we look at the horizon, we see it ripe for a period of aftershocks. It means increased volatility, and we saw that initially earlier this month with regard to the debt ceiling. We see it ongoing with regard to corporate profitability, and even furthermore with regard to the evolution of monetary policy. And when you put these things together, what it really says is that the purpose of having some balance in portfolios, some generation of income, even at these higher risk-free rates, actually is a worthwhile cause. And so one of the reasons that we were looking to establish a foothold in the front end of the government money markets was utilizing the ETF space to do this. We saw increased demand from not only retail investors, but institutional investors as well. And so for the horizon, where we see the period of aftershocks, we think it's a ripe opportunity to create some balance in portfolios that might not necessarily be ripe for additional risk-taking, but also, more importantly, create value when there are opportunities to reposition and do so while not giving up liquidity within the portfolio. And that's really an attractive trade-off right now.
Well, let's talk a little bit more about liquidity. I was having this conversation this morning with an equity fund manager who was talking about the need to remain exposed to equities, at the same time reducing risk. And she was kind of framing around this idea of picking an allocation that provides that degree of liquidity should you-know-what hit the fan and they do need to move or reallocate down the road.
Yeah, I think there's two aspects of this. There's one of thinking about being defensive in terms of your risk allocations, and we're doing that at Pimco by being up in quality, favoring agency mortgages as opposed to corporate credit and the like. But we're also thinking about liquidity within the portfolio that allows us to be offensive when periods of uncertainty become more permanent or become more prevalent, I should say, within the marketplace. And we think that's going to happen over the next 6 to 12 months. Is it going to be instilled and inspired by monetary policy changes? Perhaps not. But at the same time, the uncertainty regarding the path of Fed policy is a little bit less meaningful right now simply because of the higher risk-free rate, which means ultimately that you can have extra liquidity within your portfolios, but you need to be mindful of how you're doing that. And how you're doing that is earning additional income. So whether you're in the front end of the yield curve or in simply ultra short-term strategies which take advantage of higher quality credit spread products, there's a pretty good opportunity between earning 5 and 6% plus type of income and having that optionality. And that's where we think that the value is underappreciated by the marketplace.
I'm curious about this thought here that maybe the Fed becomes a little bit less important, at least from a market perspective. Is that based on the idea that even though we don't necessarily know when this rate hiking cycle ends, we do have a general sense here that there's only so much further it can go?
Well, I think that's one aspect. And, admittedly, this is a little bit more data dependent. In fact, this week we get more inflation numbers, which are going to sort of create a bifurcation of opinions between being core focused, core inflation focused, and headline focused, which should become inevitably lower. The point I'm making is that there are these points of volatility that will continue to happen. And in that process, it possibly makes the notion of where the Fed is going to move on each individual meeting a little bit less important. And the simple reason is that the likelihood of moves cumulatively is probably a lot less than it was a year and a half ago, meaning the damage from bond prices appreciating or depreciating, more importantly, is a little bit less in the rear, is a little bit more in the rearview mirror. Which is important because ultimately the higher risk-free rates create a better plateau for being allocated to the fixed income space right now. That's ultimately where we think that the view of the Fed comes into play. Admittedly, risk assets are going to take a cue from the Fed should they become more hawkish than the market's appreciating right now. But at the same time, we at Pimco think that there's a strong hurdle, a high hurdle here, a strong likelihood that we're going to get another rate hike here in July.
What about the whole conversation that we had, I don't know, a few weeks ago about Treasury issuance coming on the back of that debt ceiling deal? Is that going to have any meaningful impact on what we see in the fixed income space?
It is. I think there's two implications for that, and it's very important, although it is in the weeds, admittedly, for most practitioners and investors within the marketplace. The back of the debt ceiling does mean that there's an increase in T-bill issuance, but it also means that there's going to be a bit of a reshuffling of who holds T-bills, who has excess cash in the market, and ultimately the vast amount of money and excess liquidity within the market is going to go away for two reasons. One, the Treasury, the U.S. Treasury that is going to replenish their general account, as we've well stated on Bloomberg. But at the same time, we're going to be focusing on the increased need from banks, specifically regional banks, to need funding to finance their portfolios. And so there's going to be a competitive effect, perhaps even a crowding out effect between risk-free rates, excess liquidity, and who ultimately needs it.
Jerome, when we get to, I guess,
Yes.
whatever the end of this, rather Fed tightening cycle, this economic cycle, even, I guess, a fiscal cycle, if you will, there are structural changes maybe coming out of the pandemic, coming out of just the end of that easy money era here. What do you foresee over the next couple of years as being one of the more meaningful structural changes that investors should keep an eye on?
Well, number one, as you note, the notion of risk-free rates being so low obviously created a proliferation of seeking ways to create capital appreciation. The most difficult one to manage the ground is a world where risk-free rates are higher, recalibrating to the outer circles of the concentric circles of risk, as we put it at Pimco, meaning that those rates and expectation of returns have to be higher. But then more importantly, most importantly, as it is relevant to all investors, is the transactional cost of moving from one asset class to another asset class is inevitably more, greater, higher. And as a result, holding periods should have to be longer. And then finally, the cost of liquidity in and of itself, both in nominal sense and relative sense, is something that investors should keep in mind, which means having a little bit extra cash put actively into their portfolios is something that actually helps bring the expectation returns higher in their portfolios, while at the same time providing them a defensive approach to portfolio management given the uncertainty of risk right now. So there's a good variety of thinking about the transactional landscape, but more importantly, the structural changes that are going to happen over the past year, the next 3 years, the next 5 years, are noteworthy that need to change the psychology of how investors think about balancing portfolios across different risk allocations.